As discussed, a firm's value or share price will react to a change in expectations. The articles discussed in this recording are posted in Canvas in Module 1 under Expectation Announcements. For example, Dollar Tree's stock price fell 7.3% in pre-market trading after the company announced its second quarter earnings that missed profit and sales expectations. The expectation was that earnings per share was going to be 73 cents. However, the company's earnings for the quarter was only 72 cents, so it missed the expectation by a penny. However, it's interesting to note that over the quarter, the company went from a loss in the previous year from 98 million to a profit of 170.2 million for the same quarter in the previous year. In a similar fashion, the forecast consensus, the expectation was for the company to have revenue of 5.08 billion. Revenue only increased to 5 billion from a base of 3 billion. That's a huge increase in sales, falling slightly under expectations. So even though the company was materially more profitable, a loss of 98 million to a profit of 172 million, and revenue growing from 3 billion to 5 billion, the share price fell because both earnings per share was a penny below expectations and revenue was slightly below expectations as well. Therefore, we see how expectations drive changes in value. In a similar fashion, Walmart's share price surged 9% after beating earnings per share expectations. What is interesting is that earnings per share for the first quarter of 2016 was down almost 5% year over year, reaching 98 cents, but that 98 cents was 10 cents per share higher than the expected 88 cents per share. So even though the company's earnings per share fell 5%, it beat expectations, therefore share price increased. Another example of how expectations influence share prices is this July 2015 article dealing with Sprint. The share price of Sprint fell by 8% after an analyst warned of financial distress. Nothing happened other than Craig Moffett, an analyst who appeared on CNBC, indicated that he thought that Sprint is in severe financial distress, as we, meaning him, think they will be. That reset expectations, and the share price suffered its biggest one-day drop over the past several months. Nothing changed other than a potential change in expectations. An extremely interesting topic that we are not discussing is how a firm's actual performance and expectations of performance interact. For example, one might think a way to consistently beat expectations and grow a company's share price is to set expectations low and then increase the likelihood that you will beat those expectations. However, if you do that too often, then you get into a situation of quote unquote of crying wolf. Investors are very aware of the relationship between how a firm has performed relative to the setting of expectations. There is a large literature, which we are not getting into, of how one should communicate financial information to the investing public. For example, some firms do not release any expectations, often called guidance, of how they think they're going to perform. So it becomes more difficult for analysts to generate expectations. Other firms work very closely with analysts to set expectations they believe are reasonable and achievable. The point for us is that value changes when expectations change, along other inputs. That's why we talk about the market as being heavily influenced by psychology. It's because expectations drive changes in share price.